Welcome to PIMCO Pod. In this episode, we discuss how, as cash yields dwindle, the case for fixed income becomes increasingly compelling. Stay tuned after the conclusion of the podcast for additional important information. From Cash to Bonds, a strategic shift in post-pandemic investing by Richard Clarida and Mohit Mittal. As post-pandemic disruptions to markets and economies recede, long-term trends are reasserting themselves. One key signal that the markets are returning to historical patterns appeared in November, when a common yield measure on the Bloomberg U.S. Aggregate Index climbed above the Federal Reserve policy rate for the first time in more than a year. It's difficult to overstate how extraordinary it was to have a benchmark bond yield running below, sometimes well below, the federal funds rate for such an extended period. Prior to the pandemic, this had only happened 4 times in this century, and never for more than a few weeks at a stretch. This prolonged reversal in the usual market trend reflected not only the Fed's restrictive policy, but also investors' response to the extreme inflation spike and other consequences of the pandemic. Many investors retreated into cash, which offered yields not seen in decades along with perceived safety, and stayed there. Changed circumstances. 2 years later, the market landscape has transformed. Now that the Fed has embarked on a rate-cutting path, over-allocating in cash creates reinvestment risk as the assets rapidly and repeatedly turn over into lower-yielding versions of themselves. At the same time, we witnessed a profound shift higher in bond yields from pandemic-era lows. Relative to cash, where yields are dwindling as interest rates drop, bonds offer a more compelling opportunity. Consider the same core bond index yield measured against another common proxy for cash, the yield on the 3-month U.S. Treasury. Both cash and bonds offered attractive yields over the past 2 years, but cash investors by nature can't lock in those yields for longer time periods. And since September, when the Fed cut its policy rate by 50 basis points, BPS, the outlook for cash yields relative to core bonds has diminished sharply. The Fed's trajectory is not a foregone conclusion, and indeed we may see some upward revisions in officials' rate projections following the December meeting, but the data and the communications to date suggest the most likely scenario is one of gradually lower rates. The Fed is looking to secure a soft landing for the U.S. economy, with labor markets healthy and inflation near target, and it has flexibility to pursue its goals despite expected or unexpected obstacles. Example, trade policy, geopolitics, price surprises. This rate environment is highly favorable for bonds. Bonds for the long run. Based on current relative valuations and market conditions, we believe there is compelling value in high-quality, liquid public fixed income. Starting yields are attractive compared with other assets across the risk and liquidity spectrum, including cash, and historically, starting yields have been a strong indicator of long-term fixed income performance. Also, bonds are well-positioned to withstand a range of scenarios outside the baseline. Historically, high-quality bonds tend to perform well during soft landings, and even better in recessions, should that scenario play out instead. Bonds also have performed well historically across a range of different rate-cutting scenarios. Like snowflakes, no 2 monetary cycles are alike. Whether the Fed took a very gradual, higher-for-longer approach, or initiated a drastic drop, or took a downward path somewhere between those extremes, bonds subsequently out-yielded cash in each of those historical rate environments. Hedge and diversify risk. The bond market is effectively paying investors to hedge and diversify risk. Equity markets have a more checkered history with rate-cutting cycles, and indeed generally higher volatility over time. And we are in a period of heightened geopolitical unrest, along with leadership changes in major economies around the world. Bonds and equities are negatively correlated today, after moving more in tandem during the post-pandemic inflation shock. A negative stock-bond correlation amplifies bonds' potential to be a stable anchor for portfolios. Historical trends also support bonds as an attractive risk hedge. Looking back at bond and equity markets on average since 1973, During periods when U.S. core bonds are yielding around 5% or greater while U.S. equities earnings ratios are above 30, as they are today, bonds have offered higher 5-year subsequent returns and with potentially lower volatility. A fixed income allocation offers attractive yields, potential for price appreciation, and a hedge against the risk that equities or other more volatile assets see a sustained contraction. Takeaway: market signals and Fed moves mean that bond yields have turned a corner. The combination of high starting yields and anticipation for lower rates creates an attractive outlook for a wide variety of bonds. Investors lingering in cash may want to consider fixed income. Thank you for listening. That was From Cash to Bonds, a strategic shift in post-pandemic investing. For future insights, please follow us on your favorite podcast platform. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be, and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.